Well, folks, the stock market is setting up for a absolutely massive move, and I hope everybody is prepared for this. Wake up today, public count, just a beast day. $102,000 in gains in the public count here today, right? Stock market definitely recently has been, let's call it, trying to find its footing. That's the best way I could put it, right? Where it seems like, at least for the past month or so, it seems like a lot of portfolios have kind of plateaued. Right? And even looking at the public count, that kind of feels what it has happened over the past month, right? It kind of feels like a plateau situation. And we get volatility, and you get a day like today, great day, up $100,000+, right? But who knows? That could all be gone tomorrow, right? And that's the sort of market we're in right now. And it reminds me a little bit of a few time periods we had in actually 2024. So you had this time period right here where the public count kind of felt like it plateaued a bit, right? We had this time period right here where the public count felt like it plateaued a bit. But then you would have these kind of extreme moves to the upside that just kind of push the portfolio more and more, including that kind of one toward the beginning of earnings season back in 2024, right? Now you have so much conflicting data coming out left and right, and these are very substantial things, right? For instance, the LA wildfires, everybody knows that have been going on, right? It's been all covered all over the news for the past week and a half, right? $250 billion in damages they're talking about now, right? And that number is still not even final. Like, don't be surprised if it's $300 or $400 billion when it's all said and done, right? And a lot of people are asking questions like, what is this going to do to inflation, right? They're going to have to rebuild massively in certainly, I mean, it's going to take a while, right? So a lot of the rebuilding is going to happen 2026, 2027, 2028. What's that going to do to inflation, right, over the next several years? Who's going to pay out all this money? Like, people are still trying to figure out that. Like, I don't know, an insurance company's going to be able to fork over $300, $400 billion? Is the federal government going to have to do this, right? A lot of questions there. We have Trump getting in office literally in a few days from now. Literally, it's only a few days. The inauguration is coming here, right? And with that, I don't know if you guys have seen this, Musk, Bezos, Zuckerberg may sit together at the Trump inauguration, and it's just fascinating, right? Because it just happens to be three of my top four biggest positions: Meta, Tesla, and Amazon, right? Now, you also see something like this, where essentially investors week after week after week are getting more and more bearish leading up to the inauguration here. Look at this. You look at the week that ended December 18th, 31% of investors were bearish on the market the next 6 months. Then that grew to 34.1%, then 34.2%, and in the latest week, 37.4%. So 4 straight weeks where investors are getting more bearish on the market and less bullish. Look at, they went from 40.7% were bullish on the market the next 6 months to 37.8, 35.4. Now the latest week, 34.7%. So now there's more investors based upon the AI and investor sentiment, which they've been doing for decades and decades and decades, right? There's more investors bearish on the stock market for the next 6 months than are bullish. And that's a flip that we haven't seen in quite some time, right? Very, very fascinating. So I thought today, let's really focus on the market, where this market's headed, right? Because a rising tide lifts all boats, as they say, right? And if we're talking about the stock market gets its footing again, starts going up, you see the NASDAQ moving up, S&P 500, it gets a lot easier for all our individual stocks to move up in that sort of environment versus, let's say, if the market can't catch its footing, right, and it falls down the hill, it's going to be hard to get much for gains in many of these stocks that a lot of us own, right? So I thought, let's really dive in on the market and where this market's headed in this video here today, right? Obviously, here on the channel, I focus mainly on individual stocks. And why do I do that? Because individual stocks is where your attention needs to be the majority of the time. The minority of the time, you can focus on where the market's headed, but the majority of your time needs to be focused on individual stocks. That's why I always give preference to individual stock talk versus a markets, outside of maybe like a crashing market or something like that, where you just have crazy drama, okay? There's only one thing, and one thing I ask from you guys. The sign in my garage says it. I need you guys to smash that like button. I hope you can take 1 second out of your day to please do that for me. It's a huge favor. That's all I can ask from you guys. If you want to subscribe to the channel, you can certainly subscribe here to the channel. We just hit a new all-time high subscribers in the history of the channel. I believe it's 812,000 subscribers here on the main channel. So I appreciate every single person for being here, okay? Alrighty, guys. Where I want to start here, this might be surprising to some folks, but I actually want to start this video talking about Bitcoin. Yes, Bitcoin. And the reason I want to start today's video talking about Bitcoin is Bitcoin tells you a lot. It tells you a lot about where investors want to position, how they're thinking about the market moving forward. It tells you a whole story. It really does. And so even if you have no interest in owning Bitcoin, right? Perfectly fine. Always have Bitcoin on your watch list. Always keep an eye out because it's going to tell you an entire story here. For instance, right, if you look at Bitcoin's returns, since it became a more mature asset, which it really got onto the mainstream financial landscape, I would say around 2018, 2019, right? And then just kind of got more and more mainstream over the years where now it seems like just everybody knows what Bitcoin is, right? But you're going to understand Bitcoin is basically a call option and put option on the NASDAQ, okay? It's been that way, and I see it being that way for quite some time to go here in the future. So essentially, whenever Bitcoin's going on a beast run, the NASDAQ's going on a beast run. But the difference is Bitcoin's going to be way more extreme to the upside. Now it also works in the downside. So let's say the NASDAQ goes down in a particular year. The Bitcoin's going to be way more extreme in terms of its downside risk versus a NASDAQ. So that's why I call it a call option or put option based upon where the NASDAQ essentially is moving, right? And you can see this played out, right? So look at this. So Bitcoin down year 2018. Guess what? NASDAQ down year 2018, right? Bitcoin up 89% in 2019, right? I bet you the NASDAQ had a great year in 2019. Oh, did it ever? The NASDAQ was up 35% in 2019. In 2020, the NASDAQ was up 43%. I bet you it was a banger year for Bitcoin in 2020. Oh yeah, 302% gain for Bitcoin in 2020. Almost a 40% gain for Bitcoin in 2021. I bet you it was a good year for the NASDAQ in 2021. Oh yeah, it was. 21% gain for the NASDAQ in 2021, right? 2022, NASDAQ got obliterated, down 33+%. I bet you Bitcoin got hammered. Oh, did it get hammered? 65% down. And then 100% plus gain in 2023 for Bitcoin and 100% plus gain in 2024. Oh, guess what? NASDAQ, banger year 2023, 43% gain. 2024, 28% gain, right? Bitcoin's going to tell you a lot. And so what's Bitcoin telling us recently? Bitcoin's telling us that when I say ultimately, I think investors want to take more risk. They do. If you look at the trend here very recently in regards to Bitcoin, it looks to me like people are about ready to start taking risk on the market again, right? Because that's the story Bitcoin's telling us. It basically over the past month, it's been telling us a story of like investors are uncertain, right? And very recently here, it flipped in a massive way, and now it looks like investors are ready to take risk once again, right? Now, additionally, I don't know if you guys follow me on the Reaction channel. Jeremy Lefebvre Makes Money, right? But I did a video yesterday. I was talking, at the beginning of the video, I talked about Fubo, AMD, and Cake, right? But then from there, I reacted to a few videos, which I pretty much always do on that channel, right? But one of those videos was Tom Lee. Tom Lee's making a call that Bitcoin's going to 200 to 250,000 this year, 2025. By the end of the year, you'll be flipping my flapjacks. Let me be very clear about this. If Bitcoin goes to 200 to 250,000 this year, what do you think is going to happen to the NASDAQ? What do you think is going to happen to the S&P 500? It's going to be a booming year. We're going to be talking about another year where the NASDAQ appreciates 20+%. Where we have another year where the S&P 500 goes up 15 to 25%, right? And people will be like, oh my gosh, we just had 3 back-to-back-to-back banger years in the market, right? But remember, 2023 was this is what people got to understand about this, right? 2023 was just a get back of what happened in 2022, right? 2022 stock market got hammered. 2023 was like, oh, let's get back on track. From there, 2024 was a building year. 2025 could be another building year. No guarantees here, and we got a lot to go through in this video here today, but that's the way you got to kind of frame this. If 2022 was a banger year, and then 23, and then 24, right? I would be much more concerned about 25, but 23 was just a get back of those 2022 losses. That is what is important to understand about this, and that's a part a lot of people conveniently forget in regards to this whole story. Now, I don't like what I see. Look at GSG. I always tell you guys, keep this on your watch list. GSG commodity index, basically, right? It's kind of a basket of commodities, kind of tell you what's going on in the commodities cycle. And at the end of the day, everything in this world goes back to commodities, right? You want to make basically everything, it ends up going back to commodities, right? So I don't like what I see here. And the reason being is GSG is now up about 14.5% in the past year. But specifically, the much more worrying thing is the move in the past, I would say 4 or 5 months, has been rather dramatic for GSG. Specifically, since around the time the Fed made those first rate cuts, right? GSG has been up and up and up. And now we're looking at GSG at the highest point it's been at any point in the past year. And why is this? Well, it's because of crude oil. If you look at crude oil futures, I mean, look at this 12.7% move in the past month. Guys, it's winter time right now. I'm recording this in January, mid-January. Like, a lot of times you expect crude to move up in spring going into summertime, right? Obviously, major driving season, people taking trips, all that, blah, blah, blah. So a lot of people expect crude to move up in spring, move up into summer. But when you got crude moving up huge in December into January, definitely something you got to keep an eye out, and definitely something that could cause potentially problems here, right? What's going on with crude? Crude rallies. Crude and gasoline prices rallied sharply Wednesday, with crude posting a 6-month high and gasoline climbing to a 3 1/4 month high. Wednesday's weaker dollar is bullish for energy prices. Crude prices extended their gains Wednesday after weekly EIA crude inventories fell more than expected to a 2 and basically 3/4 year low. This is something to keep an eye on, guys. If I can tell you, if commodities keep running and running and running month after month after month after month, we're going to end up in, guess what? Inflation problems again. And that's not going to be fun for any of us to go through, right? Look at this here. What I'm showing, this is out of the government, okay? Real average hourly earnings for production and non-supervisory employees decreased 0.2% from November to December. That's not good. Now, you can't just make a justification based upon 1 month and say, oh boy, we're in trouble here. Because at the end of the day, you look over the past year, and clearly there's a trend of real wages being in a good spot, right? Which we need real wages in a better and better spot so the consumer can go buy a new pair of freaking Nikes, okay? So the consumer can go buy a new iPhone, so the consumer can go buy a new car, so the consumer can go eat at the restaurants, right? That's what you have to have a good economy. You need real wages to continue to tick up. But recently, if we start talking about real wages going negative again, that will lead to problems in the overall economy, okay? So this is like early indications of like, ooh, and this is part of the reason I believe you're getting a lot of this recent kind of weakness, like unsure market right here recently, is kind of looking at some of this stuff in the market saying, boy, okay, we want to see this, we don't want to see this here, right? Now, if you look at Trump, right, Trump's obviously getting in office in the next few days here. There's some potential tax changes coming. Okay, now from what I heard, he wants to do something like 100 executive orders or something like that. We'll see what happens. Okay, but the moral of the story is Trump's talked about cutting corporate income taxes from the 21% rate down to 20%, right, which would be an extra percent for all companies to have versus the government having, right? And he's talked about reducing basically the income tax rate for corporations to 15% if the companies make products in the U.S. Now, that's going to be a confusing mess because what constitutes making a product in the U.S.? What if you get a bunch of the products from outside the U.S., but then you technically put it together, okay? So let's say 99% of the products made in China, but all you got to do is just put this one screw together. I made it in the U.S., right? Like, or it's made in some other country, and then I put the one screw in. Okay, it was made in the U.S. This is going to be a complicated thing to figure out how that works, or if that even happens, okay? I think cutting the corporate tax rate just at 20% might be a lot easier to pull off that, but that's something to keep in mind, right? Now, also, Trump has talked about a universal 20% tariff on all imported goods to the United States and increasing the rate to 60% for imported goods from China, right? Also, talked about getting rid of the electrical vehicle credit, those sorts of things. So we're going to have likely some, well, if you know Trump, we're going to have some tax policy changes over the next few years, and we're going to have some tariff changes over the next few years, right? Now, the important thing to understand about this tariff situation, this is another thing that's giving some pause to the market, right? Because the market's looking at this and like, dang, is Trump serious? Is he really going to do a 60% tariff on things that are coming from China, right? Because, I mean, imagine there's an iPhone made in China and it has a 60% tariff on it. So then, is that iPhone then go from $1,000 to $1,600? Like, this is something you got to consider, right? And so that's something that gives some pause to the market once again, right? And once again, obviously Apple's outsourcing to India a lot of those products. But you could look at something like a stock that I own, Elf Beauty, right? Elf Beauty's had a lot of kind of malaise around the stock over the last number of months because it's worried about tariffs, because a lot of Elf Beauty's products are made in China, right? So, you could say, well, Elf's going to pay the 60% tariff, right? You guys can pay this. Yes, initially, but that's not the way it works. It always ends up coming back to the consumer, which then leads to, guess what? Inflation, right? So when we talk about the inflation that went out of control in 2021 and 2022, the thing you got to understand, the seeds for that were already in prior to Rona. There was already inflation talk prior to Rona. Rona was a thing that supercharged it, right? And that was what put it overboard. But we already had inflationary problems before Rona. It's just that took it crazy, right? You had supply chains disrupted all over the place. Next thing you know, you had the stimulus money. It was a whole mess, right? But we already had that because basically prior to Rona, you already had companies getting hit with tariffs. Those companies aren't going to take the hit. They're going to pass it along to consumer. That's the way it works. Like, these companies didn't get this strong and this powerful just by chance. They're always going to pass it on to the consumer. So for instance, Elf, right? If Elf suddenly has to have a 60% tariff on products, right? What do you think they're going to do with pricing? They're going to go on their Halo Glow liquid filter. They're going to go from $9 to $15 on that. On this Power Grip Primer, they're going to go from $10 to $16. On this product, they're going to go from $5 to $8. You think Elf's going to take the hit on that forever? No, of course not. Maybe very initially, but they're going to pass that right along to the consumer, and so isn't every single other company that makes products outside the country. That's what you do, right? And that's what Elf did in the first go-around as well, right? Now, let's say they outsource manufacturing to India, where maybe they face a 20% tariff or something like that instead of 60%, right? You think Elf's going to take that hit? No, of course not. They're still going to go up on this product from $9 to $12. They're still going to go up on this product from $10 to $12, and this product from $5 to $7. So whichever way you slice it, the consumer will pay that tariff. They will end up paying that tariff in the end. It's the way it works. It's the way it worked first time around in Trump 1.0. It's the way it will work Trump 2.0, man. It's the same thing, right? No. You might think this must hurt Elf's business model, right? Or you might think initially that this doesn't really help Elf, right? They're just offsetting the tariff, right? So they have to face a 20% tariff coming because they're manufacturing the product in India, let's say, for instance, right? Or some other country, Indonesia, wherever, right? Let's say, for instance, you think, oh, they're just offsetting it. No, that's not how this works. They could actually make way more money. Here's why. If you look at Elf's gross margins, the gross margins of the company is well over 70%, right? So think about this for a moment. If Elf goes from $9 to $15 and from $10 to $16 and $5 to $8, right? The gross margin dollar before, just rough numbers, back of the napkin math, right? Was on this product, gross margin dollar would have been about $7. On this product, it would have been about $7, right? Gross margin dollar on this product would have been about $3.50, something like that, right? Well, here's the gross margin dollar afterward. Now it's up to about $11. Gross margin dollar now about $12. Gross margin dollar after about $5.25. Now you gotta say Elf doesn't even have to go up that much on customers, and their gross margin dollar would still increase actually, right? They don't have to be as dramatic as they are here. And even if they outsource manufacturing and took the 20% hit, they don't actually have to go up 20% on the product to essentially have it offset and actually be incrementally helpful to gross margin dollar. So the gross margin percent could stay the same while gross margin dollar actually grows. That is very important that everybody understands that math there. Because unless you're really into business, you're probably not aware of that. The company could have gross margin percent stay the same and gross margin dollar could grow substantially. And that goes to what? The net margin. And then you're talking about net margins that are far better. So when you looked at corporations certainly got much more profitable under Trump 1.0. It wasn't just the fact that Trump went down on corporate income taxes, corporate taxes for companies, right, from 35 to 21%. That was a huge help. But the other part is things like I just ran you through there. Companies could actually increase their gross margin dollars considerably, which then helps their net margin, which then, guess what, makes a company much more profitable. Something very important. And if the company's got a lot more profit, guess what they can do? Big share buybacks. And if they can do big share buybacks, guess what it helps? The stock price. It helps the earnings per share. And it helps the overall stock market go up. Okay, so a lot there. If you need to go back over that one, rewind the video, watch that 3-minute segment, 4-minute segment again. It's very important everybody understands that for any of these companies dealing with, potentially tariffs coming here, okay? Now, I'm also seeing stuff like this. This gives me a little, this is kind of the ebb and flow we have right now, where I see some stuff that I'm like, okay, I like what I see here, and there's other stuff I'm like, I actually don't like this. For instance, I saw this today, Hindenburg, which if you're super in the stock market, you know of Hindenburg Research, right? Short seller, Hindenburg Research has said it's going to be shutting down. That gives me a little pause, because I'm like, dang, man, they're shutting down. It just makes me think, like, I wonder how long the next bear market is away, right? When I see somebody like Hindenburg shutting down, I'm like, dang, man. Like, I wonder if we're going to have a next bear market here shortly, right? 6 months, 12 months, 18 months from now. I don't know. Like, there's nothing you can draw to conclusion. It's just something that gives me a bad omen, right? Kind of feeling, right? Now, additionally, you have something like this. This is actually substantial to the U.S. economy. TikTok plans immediate U.S. shutdown on Sunday. So there's, at this point, a decent probability TikTok could be shut down on Sunday. Now, you might think, oh, what's the big deal? Like, TikTok shuts down, so what? People are, just going to have more time on their hands to not watch TikTok. You got to understand, there's a lot of businesses, including small businesses, that have built their business models around TikTok. And through the ability to go viral with content on TikTok, they built substantial businesses. I know of several just personally that benefit massively from TikTok. So if that's disrupted, it could actually disrupt companies' revenues, profits, all those sorts of things. And I'm not just talking about large corporations, I'm talking about a lot of small businesses as well. So we'll see what happens here, but that is something that actually is quite a serious matter, right? Now, opinions are all over the place in regards to this, right? This gentleman says thousands of apps are banned in China, including many popular social media platforms. Reason for bans: the Chinese government blocks apps that don't comply with their regulations regarding data collection and content control, right? Specifically that part, content control, right? And so, for instance, unless you have a VPN or something, you can't access Facebook over there, or Instagram, or even Google search or YouTube, or, basically all those ones, right? So, yeah, and it's kind of is unfair if, we can have some massive TikTok, let's say, for instance, in the United States, when our social medias aren't allowed over there, right? This one says, question, how many how many of us have seen adults, not just children, become addicted to social media and do infinite scroll, rarely looking up from their screen? And how many of us have seen the same people become hyper addicted to TikTok? Not just rarely looking up from their screen, but being literally entranced, so absorbed they'd rather live in the world exclusively than the real one. I think it has to do with the video length and dopamine rush of the hunt that comes from finding another, video, right? And so this person says TikTok needs to be gone. And that is sentiment I do agree with, but the way I'll push back against that, right, is the same people that are probably using TikTok all day are the same people that the previous generation were the type of people that as soon as they got home from work, what happened? The TV went on. And they watched TV from the time they got home from work to the time they went to bed, right? And it was the news shows, and then it was comedy, and then it was, whatever was on the news or whatever was on the TV, that's what they were watching from the time they got home to the time they went to bed. And so I think that TikTok in social media, right, has just replaced a lot of TV time usage, where I look at a lot of millennials or Gen Z, a lot of those same folks that would have been just watching TV all the time are now choosing to spend that time on Instagram and on TikTok and things like that, right? That's a difference. It's just the time went to another place. So, as bad as I don't like kind of that whole thing, it's just at the end of the day, I'm like, it's the same type of people that would rather just watch TV from the time they get home from work till the time they go to bed, man, right? Now, in terms of the TikTok situation, there's been ideas floated around about Elon Musk buying TikTok. Now, if Elon Musk buys TikTok, I don't know. That's going to be, I don't know if that's really going to happen, right? Elon Musk has kind of, hinted that that's not realistic or whatever. But the reason being is a lot of people that use TikTok, I'll be honest with you guys, they don't like Elon Musk. And a lot of those people were the same people that left X after Elon Musk bought it, right? And so I don't know if Elon buying it would be the best thing for TikTok overall, and it could actually be seen as like a positive for Facebook, for Instagram, products like that, right? Even maybe even Snapchat a little bit, right? There's been rumors about Mr. Beast buying it, and supposedly a ton of actual billionaires have reached out to Mr. Beast to kind of, basically because Mr. Beast doesn't have the money to buy TikTok. Like if it's sold, the valuation is likely going to be somewhere between $30 billion and $50 billion. Mr. Beast certainly doesn't have $30 to $50 billion. But if he's got a bunch of billionaires that partner around it, right, to back the buy, that could happen. Or maybe it just goes dead. But it's hard for me to see ByteDance just let that one go. Because, we're talking about they could probably make $30 or $50 billion off selling it to somebody. So I don't know what's going to happen here, but that's a serious matter that has to be considered out there, right? Now we go back to inflation. And the reason I want to go back to inflation is because so many things end up coming back to inflation, right? So U.S. consumer prices post largest gain in 9 months, underlying inflation slowing. So the latest CPI numbers that just came out, 2.9%. That's good. Like if we can have CPI anywhere between 2.5% and 3.5%, we're good. Like fine. Like that's what we've traditionally had, and we've had very healthy economy with inflation rates somewhere between 2.5 and 3.5. The issue though is, if you look at the trend, what is the trend? The trend is higher for CPI, which means if CPI just keeps going up, inching up, and next thing you know it's at 3, 3.1, 3.2, 3.3, the Fed's not going to be able to lower interest rates in the next 6 months, the Fed funds rate, right? And if they can't lower Fed funds rate in the next 6 months, the market might get a little concerned about that because the market was hoping that the Fed would be, let's call it going much lower over the next 12 months. Now, keep in mind, even the Fed lowering recently has obviously spiked Treasury yields, which, that could be seen as a negative thing that hurts the market. So the Fed lowering, I think the market got a little confused and think things it's like easy, like the Fed just lowers rates and, it's all up and up and up. Not really. And that leads us into the real estate market, right? And the real estate market can be very tied in with the stock market over time. But here recently, mortgage rates are back over 7%. I'm sorry for anybody that's looking to buy a house out there in the next few months. Brutal, man. Brutal. I think it's brutal for buyers and sellers the next 6 months because for the buyer pool, they're looking at it and they're like, I got to pay 7-something%, right? Like that's kind of crazy. So that takes a lot of buyers out of the market. They're going to say, screw this. I'm not buying right now. Just forget it, right? Sellers, on the other hand, if you're trying to sell a property with a limited buyer pool, I don't think you're going to have much for pricing power. I just don't, which means I think it's just, once again, kind of a stalemate market. And I think it's just a brutal market if you're a buyer or seller right now, right? And the reason being is if you look, from basically 2008 through 2022, everybody's got brainwashed into thinking 3 to 5% mortgage rates is where you're going to be, right? So when all of a sudden you're talking about being 7% plus, when everybody is in this mindset of 3 to 5%, it's hard to wrap your head around that. It's hard to think like, I'm going to go sign up for a mortgage at 7.1% or something like that, when you might have a mortgage rate now at 3.1% or 2.9%, right? Or 4.1%. Like whatever your number is, it's probably way lower than where things are at right now, right? And obviously it hurts affordability in a substantial way. That leads us into the national deficit, which currently we're already at $711 billion in the hole already in this fiscal year, right? Which is around a 39% worse number than at this time last year. That's how bad things have really gotten national deficit. And a lot of that has to do with interest. In 2025, interest payments are projected to be $1 trillion. $1 trillion. That's insane, right? The national deficit's out of control. What's going to happen in regards to this? I don't know. Because the thing is, if you really want to bring down the national deficit, we're going to need to take some short-term pain for a few years. If you really want to bring down the national debt, that's also going to take a lot of pain. And I just don't think politicians are ready to take that pain. And the reason they're not willing to take that pain is because the people aren't willing to take that pain. And as soon as here's the thing, if you really want to bring all this stuff down, it's going to end up hurting GDP. It's going to end up hurting jobs. It's going to end up hurting a lot of people. And guess what happens when people are hurt? They vote out the current politicians. And the next ones are voted in, right? That is, say they're going to save the day and they're going to do this, and they're going to do that, and they're going to spend more money, blah, 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 right? So that's a whole situation that's going on. Now, I will say it's a great time to be rich. It's a great time if you're rich out there, right? Because at the end of the day, you look at treasuries, you got a 3-month treasury yield 4.3% right now, right? You got a 6-month yield right around 4.3% right now. You got a 30-year yielding close to 5% right now. Treasuries have been going back up, right? So if you got money, which rich people got money, think about this. You're a top 1%er. You got $1 million on the sideline right now in treasuries. You're making $40,000 to $50,000 a year from just interest on guaranteed money from the government. The far majority of people in this world don't even make close to $40,000 to $50,000 a year from their job or their business, right? The far majority of people in this world. And the fact that you could just sit back with a mill and make $40,000 to $50,000 a year, whew, that's substantial. That's substantial, right? Now, people might think hiding in treasuries is like the smart move, right? Because you look at stocks, you might say, ooh, markets, it's not at all-time highs, but it's toward all-time highs, right? You look at Bitcoin, same exact thing. You look at real estate, not ideal. So you might think hiding in treasuries is a smart move. But hiding in treasuries is not always a smart move, even if you can get that guaranteed 4 to 5%. And here's why. Think about it like this, right? The public account in January 2023 was around $1 million roughly. Let's say I had that $1 million just in treasuries over the last couple of years. Right now, the public account would be sitting somewhere between, I would guess, $1.1 to $1.2 million, right? That's what I would have in the public account. Instead, because I'm in individual stocks, I have over $3 million in the public account, not 1.1 mil, right? So we're talking about a substantial difference. You might say, well, that's just because you're in a lot of great stocks that have gone up a lot over the past couple of years, like Meta, Elf, blah, 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 right? Palantir, all those stocks. Well, even if you'd been in the S&P 500, you made over 20% gain in 2023, right? You made over 20% gain in 2024. And versus treasuries got you a maximum of what, about 5%? So even if you had just invested in S&P 500 index funds, you destroyed the returns versus treasuries. So I understand it can be very tempting to say, I'm just going to park my money in treasuries. But as somebody that knows several high net worth individuals, top 1%ers, right, that have been hiding in treasuries the last couple of years. And you know what they tell me when I speak to them? Jeremy, oh, did I mess up? Why didn't I just put in an S&P 500 index fund? I didn't even have to do individual stock. I could have just done an index fund and made 20+% per year. I mean, if you're talking about combining that total together, you're way over 50% gain versus maybe 10%-ish gain in treasuries. Huge mistake. So I understand it can be very tempting, but a lot of times the smartest, it looks like this is the smartest place to put money. A lot of times it ends up not being that, right? Now, I wanted you to pay attention to this right here, because S&P 500 is technically down so far to start the year, right? But here's what's interesting about this. If you look, the S&P 500 usually goes up in January. Usually January is a very good month for the stock market. So we have one of two phenomenons going on here. One is we got to play catch up here. And there's a lot of catch up to be played for the S&P 500 to bounce back. And the next thing you know, it's going to have a 1.5% or 2% gain by the end of this, right? Or there's actually something wrong with the market. There's something really wrong. Now, in order for something to be actually wrong with the stock market, you need what? You need earnings to tank. If you want to know how we got the massive bear market, crash market in 2008 into the beginning of 2009, it wasn't just we had this problem, that problem. Earnings tanked. The biggest stocks in the market, their earnings collapsed. And the stock market collapsed. How did we get that massive crash we had in 2022? Well, look at the earnings of all the strongest companies in the stock market. Their earnings tanked. Look at the back half of 2022 through the beginning of 2023 and what happened to their earnings. Look at Amazon, look at Meta, look at all the big dogs, Tesla, blah, blah, blah. Go through the whole list of them. Their earnings fell off a cliff. And the stock market fell off a cliff. So we can always point it to treasuries or what happens with the Fed and blah, blah, blah. At the end of the day, it always comes back to actually earnings, right? So that leads us into what's about to transpire here. Because here's the deal, okay? What I sorted you here is the biggest S&P 500, components, right? As far as a weight. Apple's over 7% weighted S&P 500. Nvidia's 6.5%. Microsoft, Mr. Softy's over 6%. Amazing's over 4% of the S&P 500. Meta's over 2.5%. Google McDougal is, if you combine it, right, we can call it about 3.5%. Tesla's over 2%. Broadcom, otherwise known as Vago's over 2%. Berkshire Hathaway 1.6%. JP Morgan 1.4%, right? So here's the deal. Apple's reporting in the next few weeks. Nvidia's reporting in about a month or so. Mr. Softy's reporting in a few weeks, within the next few weeks. Amazon next few weeks. Meta next few weeks. Google McDougal in the next few weeks, right? Tesla in the next few weeks. Broadcom will probably be about 2 months out. That one's a little further out. Berkshire Hathaway in a month or so. And then JP Morgan's literally in the next few days. JP Morgan's reporting, right? Look at this week. And keep in mind, a lot more companies are going to come out and announce they're going to be reporting earnings somewhere between here, right? But look at this week already. You got SoFi reporting on the 27th, right? You got Boeing reporting on the 28th. The 29th, you got Tesla, Meta, and Microsoft all reporting on the 29th. The 30th, you have Apple reporting, right? I mean, we got an onslaught coming. And then Amazon's somewhere in this mix as well. Where's Amazon at? Amazon's going to be reporting somewhere around here as well. I'm just not sure exactly what day Amazon's reporting. They might be reporting on the 30th. Maybe they haven't announced yet. But the moral of the story is we're about to have earnings. And here's the deal. If earnings come out good, guidance is good, you know where the stock market's going? Higher. If earnings come out bad, guidance is bad, conference calls are bad, guess where the stock market's going? I don't care what the Fed's doing or what inflation's doing. Stock market's going down. It's as simple as that. It's literally as simple as that, right? Now, how am I positioning for this? And how am I positioned going into this earnings season? I have no hedges going into this earnings season. Zero. Like Robert De Niro, I took all my big, huge profits on all my hedges. I'm out. I am not banking on this market tanking on this earnings season. But with that being said, I kind of hedge a little bit. And the reason being is I got a really good cash position right now. That's over there yielding me that 4 to 5% right now, right? And so I'm not even close to all in this market. So if we do have fireworks and this market tanks, let's say for whatever reason, I'll be happy to deploy $100,000, $200,000, $300,000 into this market in the next, we can call it in February, March. Let's say, whatever happens, drama, boom. Cloudy conference calls, whatever, right? No one's going to spend on AI anymore, whatever, right? I'll be ready to buy and gladly take shares off people's hands. But I'm not banking on that at all. I really think there's a lower probability of that happening, right? And I'm heavy, the top 1% type income statement and balance sheet companies. Like if you look at where I'm most positioned, it's top tier balance sheet and income statement companies, right? Why? Well, because I want companies that are making insane profits, right? So then they can take those insane profits, do share buybacks with them if they choose to, or pay dividends out to me as a shareholder. They can build their balance sheet even stronger. And the companies with the best balance sheets are the most well positioned right now because they don't have to worry about taking out debt at high interest rates. Meanwhile, they're able to generate 4 to 5% on all that cash they have, which just prints them even more money. It's a phenomenal thing, right? And even if you look at some of my weaker companies, like let's call it the smaller positions I have, right? Even those ones have positioned themselves with now very good balance sheets, right? And income statements. Like look at Honest, like their income statement has improved by 1.5 miles, and their balance sheet is now actually very, very strong. For a small cap company like Honest, their balance sheet's a beast now at this point in time, right? Fubo, you look at what their balance sheet's going to be looking like after that deal gets through, and then they're talking about being cash flow positive after the deal goes through as well. And plus their financials, they have been continuously improving prior to the deal going through as well. They're setting up well, right? SoFi, this was a $6, $7, $8 stock. Could definitely be seen as one of the weaker stocks I have, smaller position for me, right? But you look at SoFi, I think they're actually in a very good financial standing. I mean, you look at their income statement and how much that has improved, right? Flipping over to profitability. You look at their balance sheet. You look at their leverage ratios. SoFi is looking pretty dang good. So even my weaker stocks, right, when it comes to income statements and balance sheets, even those ones are actually pretty dang impressive. Never mind my top tiers. When you look at the Metas or the Teslas or the Amazons, like some of those big dog positions I have, PayPal. I mean, those are some of the biggest money printing companies literally in the world. It's unbelievable, right? And so That's where I'm positioned. That's kind of what I'm expecting. I'm expecting more upside than downside. With that being said, if we get that downside, I got the cash ready, baby. The chambers are loaded. The chambers are loaded. Now, whatever happens here, just make sure you're focusing on long term. We call that Richville. Long-term mindset is Richville mindset. Short-term mindset, all this, I got to try to get in at the perfect time. That's Brokeville, man. That's Brokeville mindset. You're never going to get in at the perfect time. You see great opportunities in the market. Take advantage of those opportunities. You wait around, you end up regretting because it's going to pass you by. It's going to pass you by and you'll be like, dang, man, that stock was blah, blah, blah price. I had an opportunity to buy it and I chose not to because I was afraid it might go down a little bit more. Or I thought I could get it 5% lower than what it was trading at. Give me a break, man. If you're buying great companies, who cares? It's like Meta back in the day when I was buying that, right? 2022. Like, I bought that stock at probably $120 something. I bought it under $100. I could have been like, I remember the day I bought it for $88.94. I could have easily looked at Meta and be like, oh, $88.94. You know what? I think it's going to go down even more. I'm going to wait till it goes to $78. Guess what? It never did. It never did. And I never would have bought it, right? Like, it's just such a silly mindset to think I'm going to get it at the perfect pricing. Who cares? And if the stocks go down in the short term, who cares? What do we know about every crash scenario in the history? Every single one's a huge buying opportunity. Every single one. Show me one crash that ever happened in the stock market that wasn't a gigantic buy the dip opportunity. Show me even one. Doesn't exist. They were all great buying opportunities, right? Show me one massive crash where it wasn't an unbelievable opportunity to be buying the greatest companies in the world. It doesn't exist. So the moral of the story is focus on Richville, which was focusing on the long term, and stay away from that short-term mindset, man. That's Brokeville, man. And I've been proud to build, I think, one of the greatest communities in the history of the stock market in terms of just a lot of people that are very focused on the long term, having that sort of long-term mindset and don't get caught up in all the short-term crap, right? We keep each other up to date on everything that's going on short-term, but we don't buy into this whole, trying to perfectly time into this stock and that stock in the market, and we're in the market, out of the market. Heck no. No. Okay. We're all focused on long-term, building our portfolios, and what I teach works. Like, the amount of people that have gone through my private group over the past few years and have then accomplished 6 figures in the market, multi-6 figures, 7 figures, multi-7 figures, 8 figures, right? It's a massive, massive group. Our Hall of Fames are loaded, right? And keep in mind, probably only maybe half of people send in photos. Like, it's crazy, like how many awards I've shipped over the past few years of people that have reached 7 figures, 6 figures in the market is astronomically high, right? So if you want to join myself and other investors and focus on the long term, focus on scaling your portfolio, take this game much more serious, pin comment down there, click on that, fill out a form. We'll see if we can get access to all that. It's not just about the community. It's about all my course curriculums that teach you everything up here in my bald head, okay? Become a Master Stock Market course, Millionaire Playbook course, Stock Options Mastery, Dividend Investing Mastery, Financial Statements Mastery, all that stuff, plus exclusively weekly videos from me. Plus, if you want access to my premium software, which is 1000xstocks.com, the research platform, we can bundle all of that in for you as well. Pin comment down there, fill out a form. Let's get you taking investing a little more serious than where you're at right now. Much love and have a great day.